Welcome to the new era of digital asset taxation. If you have ever bought, sold, or traded cryptocurrency, NFTs, or other digital assets, the 2026 tax filing season is about to introduce a major change to your mailbox. For the first time, millions of Americans will receive a Form 1099-DA. This isn't just another tax form, it represents a fundamental shift in how the IRS monitors and taxes the digital economy. In today's video, we are going to break down exactly what this form is, why it exists, and how it will impact your tax return in 2026. To understand Form 1099-DA, we have to look at the DA, which stands for digital assets. In the eyes of the IRS, a digital asset is any digital representation of value that is recorded on a cryptographically secured distributed ledger or any similar technology. This includes familiar names like Bitcoin and Ethereum, but it also covers stablecoins, non-fungible tokens or NFTs, and even certain types of wrapped tokens. Previously, reporting these transactions was largely a manual process for taxpayers, often involving third-party software and a lot of guesswork. Form 1099-DA changes that by putting the reporting burden on the brokers, the exchanges and platforms where you trade. The introduction of Form 1099-DA is part of a broader effort to close the tax gap in the crypto space. For the 2026 filing year, which covers transactions made during 2025, centralized exchanges and certain decentralized platforms are now classified as brokers. This means they are required to track your transactions and report them directly to the IRS, just like a traditional bank or stock brokerage does with a 1099-B. When you receive your 1099-DA, the IRS has already received a copy. This means that for the first time, the government has a clear automated window into your digital asset activity. When you open your Form 1099-DA, you will see several key data points. The most important fields are Box 1F, which shows your gross proceeds, and Box 1G, which shows your cost or other basis. The gross proceeds are the total value you received when you sold or exchanged an asset. The cost basis is what you originally paid for it, including transaction fees. The difference between these two numbers determines your capital gain or loss. You will also see the date the asset was acquired and the date it was sold. These dates are critical because they determine whether your gain is short-term, taxed at your ordinary income rate, or long-term, which typically enjoys a lower tax rate if you held the asset for more than a year. One of the most complex parts of the 1099-DA is how it handles transfers. If you move Bitcoin from a private cold wallet to an exchange to sell it, the exchange might not know what you originally paid for that Bitcoin. In these cases, the 1099-DA might show a zero or unknown cost basis. This is a potential trap. If you don't correct this on your tax return, you could end up paying taxes on the entire sale price rather than just your profit. You will need to use your own records to provide the correct cost basis on Form 8949, which is the detailed form that supports your Schedule D. The One Big Beautiful Bill Act has added another layer to this. For 2026, there are specific provisions regarding how digital assets are treated if they are used for payments rather than just investments. If you use crypto to buy a cup of coffee or pay a bill, that is technically a disposal of an asset and is a taxable event. The 1099-DA is designed to capture these transactions more efficiently. Additionally, the new law clarifies that wash sale rules, which prevent investors from claiming a loss on a stock if they buy it back within 30 days, are being more strictly applied to digital assets. You can no longer sell your crypto at a loss on December 31st to lower your tax bill and then buy it back on January 1st without triggering these rules. Accuracy is paramount with the 1099-DA because the IRS's automated systems will be looking for a direct match between what the broker reported and what you put on your Form 1040. Discrepancies are a leading cause of IRS matching notices, which can lead to audits or penalties. You should expect to receive a separate 1099-DA from every platform you used. If you traded on Coinbase, Kraken, and Uniswap, you might have 3 different forms to aggregate. It is your responsibility to ensure that every single one of those transactions is accounted for on your 8949 and Schedule D. Because digital asset taxation is still a rapidly evolving field, the rules can be incredibly complex, especially when dealing with decentralized finance, DeFi, staking rewards, or airdrops. If you find yourself overwhelmed by the data on your 1099-DA, or if you have thousands of transactions across multiple wallets, you should not try to guess your way through it. It is strongly recommended that you seek the advice of a qualified tax professional, such as a CPA or an enrolled agent who specializes in digital assets. A professional can help you reconcile unknown cost bases, handle complex transfer logic, and ensure you are taking advantage of all available deductions under the new 2026 laws. Taxes are complicated, but the penalties for misreporting digital assets can be severe. When in doubt, call in an expert to ensure your 2026 filing is accurate and optimized.